Here's an excerpt of an interview I did with Jim O'Shaughnessy. He's the author of many best-selling books on investment, such as What Works on Wall Street. He's the co-host of the Infinite Loops podcast. And if you follow him on Twitter, you'll see that he's the master of the GIF. In this excerpt, he talks about what to do during a market crash, but also about the psychology of investing, which he thinks is really important and actually led him to talk about behavioral investing before anybody else was talking about it. And if you do want to see the full uncut video, that's available to our Patreon supporters. You'll find a link in the description below me and above me. So here's Jim talking about what to do during a market crash. And that kind of leads on to another question which I had from someone in the community, which is, what should you do in a market crash or in a boom? I'm assuming you're going to say nothing.
That's exactly right. That's what I'm going to say. Nothing. Look, so another thing that is sometimes very difficult for people to really comprehend is probabilities are very different than possibilities, right? So we conflate the two often. And we are hardwired to be hyper alert and aware for danger, right? And I was just talking to a friend about this yesterday, and it's obvious why we were. Right now we are the apex predator on this planet, and yet we are the weakest at birth. We are helpless, and the reason we became the apex predator was this little boy here helped a lot, working in groups, tool using, etc. But what often happens is when the reptile brain, which rules emotions, gets engaged, you have no idea of the power of that. It literally shuts your executive functions down, and it's fight or flee. And you immediately get drawn to whatever the most apocalyptic thing in a bear market, right? That the market is going to, it's when the headline, when the market's already down 40%, the market will drop another 40%. And literally people see this as life-threatening. And I understand why they do, right? Because they're saving for their future, for their retirement, for their kids, for a whole host of really good reasons. But probably not, right? So could the market drop like it did in the Great Depression? Yeah, it could, definitely. And, might it take a long time to recover from that? Yep, that could happen. Do I think it's going to happen given the way that policy has evolved? No, I don't. But I've always open to the possibility that it could, but the probability, very low. So if you keep your ability to focus on the higher probability event happening and avoid all of those terrifying possibilities, right? Because, my God, anything's possible. Imagine if you led your life based on the worst possible things that might happen. You'd never leave your house. You'd probably be in full armor and, heavily armed. So that's the bear market side, right? The trickier one is on the boom side, because that is a whole different set of emotions, right? That's where greed kicks in. And obviously it's like, playing the game of who gets the last chair when the music stops, but you're on the Titanic, right? You should be looking for a life preserver rather than a chair. But the point is, greed is very different to deal with, because what happens during these kind of, incredible booms is you keep reinforcing, right? And not you, the market keeps reinforcing, right? And so a great example is from history, and again, that also shows you we haven't changed at all, is Isaac Newton and the South Sea bubble. So if you watch Newton's behavior during it, yeah, he was invested early on, and then he sold and made a very nice profit. And he watched, and the share price just kept going up, and it kept going up. And it got to the point where Newton, probably one of the smartest guys, Leibniz would probably argue with that, but probably one of the smartest guys alive at that time, bought back in right near the top, lost his entire fortune. It caused him to lament that he could measure the motion of heavenly bodies, but not the madness of men. And listen, the madness of men and women continues to price securities. And, you know, if the guy who invented physics and calculus, again, with a nod to Leibniz, can't figure this out, I mean, what chance do you have? So my point of view is I'm lucky because, right, I invest, I'm always fully invested because even though I'm 60 years old, my time horizon is infinite because I have 3 grandchildren, I have 3 children, and I have a lot of charities that I want to leave things to. So I'm lucky because I'm not a target date guy, right? My target date is infinity. And so that's very helpful. But I just stick to the strategies, and when the inevitable blow off comes during those times, I haven't changed the amount I invest. I always am pretty much fully invested. And, you know, I keep a cash buffer for real emergencies. And sometimes I will use that cash buffer, but it's like you'll see very few forecasts from me, right? I mean, in my entire career, I wrote one called The Internet Contrarian in 1999, and then foolishly started an internet company. More on that later. But I also, in March of '09, wrote A Generational Buying Opportunity, not because I had any insight, but because the numbers were screaming. Guess what? This hasn't happened since the 40s, where we see this kind of downturn where bonds are long bonds are outperforming equities over the previous 5, 10, 15, 20, 30-year period. Last time that happened was in 1944, I think. And then marry that to looking at the 50 worst declines, real, so inflation adjusted, back to the late 1800s. And there's not a single negative number when you go out 3, 5, 7, 10 years. So the probabilities looked really attractive there. So I did take some of that excess cash and put it into the market. But other than that, those kind of things very rarely happen, right? And so my advice is pretty much, you nailed it. But let's extend it. Find a process that's right for you, okay? Understand, don't judge that process by a single outcome. That's like a rookie mistake, right? Isaac Asimov has a great quote, which is, unlike chess, life continues after checkmate, right? So if you have a great process and it leads to a bad result, a single result, my friend Annie Duke calls this resulting, you're not going to do well. But if you think in aggregate, and that's why I love base rates so much, right? And you think about, okay, so this strategy overall rolling 10-year periods beats the market 75% of the time. Well, you know going in, 25% of the time it's not going to work. And it, by the way, it doesn't have to be my process. In fact, it shouldn't be. It should be a process that you are comfortable with. And this obviously is advice for active investors, right? Passive investors, I think, literally should set it and forget it. You know, I advocate a world ETF. A lot of people say that there are reasons you should just own the US. I think that that's short-sighted. And, you know, there are a lot of great, very cheap world ETFs out there. And you're saving for retirement. Spend your time doing other fun things, you know. I find that people who are obsessed with the market, you really have to be obsessed with the market to go down all these rabbit holes. And I have been since I was 18 years old. And I think it's kind of, I always looked at the market investing as the Olympics of business, right? Because there's so many different things you need to understand to do it well. And that excited me. And, but anyone watching who's like, that's crazy, then ignore me and index your money in an ETF and follow your passion, be it literature, music, painting, whatever it is.
So you don't believe in just reading finance books. You really like people who delve into philosophy, and you talk about this on your podcast a lot. You can just tell from the guests that you have, which I absolutely love. I love that Catholic approach to knowledge.
Thank you. Thank you.
My doctorate was in biophysics, so I kind of like to throw my net wide as well. But
Sure.
Why do you think something like evolutionary theory would be interesting to investment people?
Yeah. So I have come to believe over the years that if you do not have an understanding of human nature, you're probably going to fail as an investor. And that's because at the end of the day, human beings are still pricing securities. And while markets change minute by minute, human behavior barely budges millennia by millennia. And so I often say that arbitraging human nature is the last sustainable edge in the market, which leads me to the idea that I better know a lot about human nature. And so thus the reading in philosophy, thus the reading in evolutionary biology and psychology, evolution in particular, because there was an interesting paper done a few years ago that is included in my pinned tweet on Twitter, where two PhDs took a look at the behavior of identical twins in investing. And I think it was done in Sweden, if memory serves. The headline here was, their conclusion was 45% of investment behavior is genetic and cannot be educated against. That's the really important one. Cannot be educated against. And so, I was one of the early proponents of behavioral finance. I wrote a paper in the late 80s. Basically, it was all behavioral finance and quant. But they didn't call it that then, it's just good old psychology. And so the problem there, though, is that we've known about behavioral problems and biases for more than 100 years. If you do your research, it goes way back. And so we know about it, we scream it from the rooftops, and it doesn't change people's behavior, which I find very interesting, right? So since at least as long as my career in markets, which started in the 1988, probably 1987, it's not changed at all. And so understanding the evolutionary reasons for this, I think, are very, it offers you great insight, but it also offers you the ability to remain dispassionate in markets. I think that people, I always say the four horsemen of the investment apocalypse are fear, greed, hope, and ignorance, right? And if you think about it, ignorance is the only one that's not an emotion. And so if you understand the process by which emotions get ignited, and you understand that they literally shut off the executive brain and they go right to the reptile brain. And listen, some of the smartest people I know, I have seen become emotional basket cases in market meltdowns. And I think what differentiated them from like our approach is because we've done all of this research that is completely outside of finance or a traditional finance thinking and program. It gives us the ability remain dispassionate, right? Because it's hard. Anyone who thinks that they are not going to be affected is fooling themselves. Because I once participated in a thing a friend did, and it was like, what is your biggest behavioral bias, and what do you do to correct it? And I answered very briefly, my biggest behavioral bias is that I am a human being. I corrected it by becoming a quant and never overriding the model. And look, that's right for me. And let me hasten to say, there are many paths towards success in the marketplace. And I haven't cornered the market on the particular way. I've found a way that's right for me, right? And for the clients who find the way we approach markets appealing. That does not mean that there aren't a lot of other approaches that also work. But my caution would be, if you don't know about the way humans respond all the time, I borrowed the term human operating system from a guy on Twitter because I love it, because I find that it removes from people the idea that I'm talking about them. One of the things that I see time and time again is that everyone thinks that the things I'm discussing, like all of these behavioral failures, apply to other people, but never to me. I am the only exception. That's not true. And what's interesting is I have found that some people, I know a lot of very, very smart people, right? And so the trap there is they fool themselves and think, well, that happens to people who aren't as smart as I am. But I've got a PhD and my IQ is 155, and I'm never going to be fooled. Wrong. Really smart people think up much better narratives to convince themselves of why they're right, because they're smart. So, you just look at things like long-term capital management, and you look at people with incredible intellects failing, and we are not immune. None of us are immune. And the more we understand that, the better it's going to fortify us during both times of despair, bear markets, but also during times of crazy elation, right? I saw a song on YouTube that just kind of popped up. My grandchildren sometimes use my computer, and so sometimes I see some really cool things. Anyway, it was a song by Ricky Martin from 1999. I can't remember the title of it, but it like epitomized the era. And by that I mean everyone was so giddy, and mimetic transference, which basically means we copy other people, right? That's another thing that I think people would do very, very well to understand, because mimetic transference, mind viruses, now we have social media, which weaponizes these things. And the more you know about it, the more you can say, well, better have my guard up. So yeah, that's why I think philosophy, I've been quoting and reading, and I did threads on, how Lao Tzu in Taoism can make you a better investor. Ben Goodspeed, who's now deceased, unfortunately, but wrote a great book in, I think it was the 80s, called The Tao, TAO, Jones Averages. And it was basically whole brain investing. I refer to that quite a bit.
And I mean, one of the questions from the community was, everybody's got these biases, but how do you overcome it? And I know that one of the things you always talk about is keeping a journal. And not only keep a journal, but keep a written journal, because you go back and rationalize what you've done and you forget what you've done. So I think that's always a good idea. What I always tell my community is write down if you're planning to do something, sleep on it, and maybe if it looks okay in the light of day the next day, maybe then act on it, but maybe not.
Yeah, that was Alexander the Great's strategy. He and his generals would decide a course of action, and they'd all agree. And then they would get rip-roaring drunk. And if the next day when they woke up horribly hungover, they still believed it was good, they did it. If then when they woke up, they were like, ugh, yeah, we probably shouldn't do that, they didn't. The power of the written journal is another thing. There are so many tools that just through tiny amounts of effort are incredibly useful. Written journals are one of them, because our brains are really, our minds are really interesting things. And I kind of think these are quantum computers we're running around with. And I often say that we are deterministic thinkers living in a probabilistic world. And sometimes change that to we are quantum creatures living in Newton's universe. But one of the things the brain does, and I've seen it because, back here, if you could see it, there are boxes and boxes, and they're all my journals from when I was 19 on. And one of the quirks of the brain is it literally changes your memory to make it more consistent with your current beliefs. That's hard to believe. And the only way you're going to believe that, anyone watching this, I would doubt they're going to take my word for it, right? They're going to say, he's crazy. But I've seen it in my own case so many times that when you first realize it, it really freaks you out. Because essentially what happens, and I say that this is the brain doing us a kindness, right? And the kindness is, it's preserving the illusion of control, right? Human beings wouldn't do well if we didn't have an illusion of control, right? That's why we like narratives. That's why we like explanations. That's why we like all of these things. And that's why you see all these idiot headlines. Market fell because of, and you could randomize an AI and people would go, yeah, that's right. It fell because of that. And there's a GIF that I use a lot on Twitter with this young kid going, because of reasons. But it's the way our brains are organized. And so when you first look at the first time you see it, right? When you're talking to somebody and you said, wow, yeah, of course I knew that was going to happen. And then you go and read your journal and you see, no, I actually had exactly the opposite opinion. A really good example that doesn't have to do with investing, but with the US, the first Iraq War, right? Not George Bush Jr., but Sr., right? When Hussein went into Kuwait. And so I believed that I supported that. And then I went back, and I wasn't looking for it, by the way. I was looking for something else. But I found an entry that I wrote at the time. I didn't support it at all. I thought it was dangerous and that, it would get us ensnared in all sorts of horrible things. And I'm reading this, I'm like, okay, this is just bizarre. And then, of course, famously, I believed that I knew about the market crash of 1987. No, I didn't. The fact is, I had amassed, I was using a much different technique back then, but I had amassed the biggest put position I'd ever had in my young life. What my memory forgot to remind me of was that I sold it the day before the crash. So it is tricky, and having it, and there's actually some studies, by the way, that find that you must write by hand because it connects to a different part of the brain than typing or recording does. And so I do that. I think if you ask me, Jim, what would be the couple of things that viewers of this program could really improve their investing? Give me two. Keeping a written journal might be number one, because we forget and then we backfill and we have hindsight bias. And again, all of us. So you're not exempt. If you think you're exempt, you're wrong. So written journal, understand human behavior. Boy, if you can do those two things, you're going to be miles ahead of a lot of other folks.
So some incredible honesty there from Jim, who certainly admits that he's not immune to these cognitive biases himself, but also some practical tips about how to avoid those biases by keeping a journal and just being aware of those limitations in our behavior. And if you enjoy our videos and you want to see us continue producing them, you can now support us directly via YouTube. There's a link that should be beside me, which you can click on, and there should also be a link in the description below me. So, as always, thank you for listening.